All right, this is Ubaid on behalf of Electronics, and in this video we'll continue where we left off in the last video. So let's assume that you have three other components, okay, that change because of the factors in the economy. Okay, starting with investment. Okay, so let's say we have investment over here. All right, and when it comes to your investment, what's going to end up happening is as there's a reduction in the rate of return, okay, if the ROI goes down, okay, your aggregate demand will be reduced. Okay, so aggregate demand, because obviously consumers, or in this case, we're talking about business investments, so businesses would like to invest in places where they can see a return on their investment. Okay, especially when it comes to capital assets such as land, building, equipment, machinery, so on and so forth. All right, next up, you have your interest rates. So as the interest rates go up, so rise in interest rates. So as the interest rates go up, what's going to end up happening is the demand investment will go down. Okay, so aggregate demand for investment will go down. Because obviously, if the interest rates are high, okay, the cost to invest in a capital asset will be high. All right, the cost to borrow money to invest in a capital asset will be high. Your monthly mortgage payments, for example, would be high. Okay, as a result of which the businesses will spend less on capital investment. They will reduce their investments, okay, just because the interest rates go up. All right, drop in business confidence. Okay, this has to do with trade. Okay, for whatever reason, let's say foreign policies, okay, tariffs, okay, so on and so forth. If there is a drop in business confidence, okay, if your trade is not consistent from time to time, okay, because of which the other party suffers for whatever reason, and let's say there's a drop in business confidence, what's going to end up happening is the aggregate demand will go down. Okay, so you have business confidence and AD will go down. All right, now apart from that, okay, when it comes to investment, as the expected rate of return, okay, let's say the ROI in this case, as the ROI goes up, the aggregate demand will go up. Okay, because obviously businesses are making more money off their investments in capital assets, as a result of which the demand for those investments will go up. Okay, drop in interest rates. Okay, so if the interest rates drop, the businesses have to spend less money to borrow and they have to spend less money to invest in capital assets, as a result of which your aggregate demand for investments go up. All right, now apart from that, you also have rise in business confidence. So rise in business confidence, this may have to do with domestic businesses, they may have to do with international businesses. So if a nation, for example, exports goods and let's say business confidence goes up, okay, this will allow the domestic businesses to invest in capital assets nationwide. Okay, so rise of business confidence. And that covers the businesses that one business trades with within the economy, so within the nation. All right, so rise of business confidence as the confidence, rise of business confidence as the confidence goes up. All right, so rise of business confidence as the confidence goes up, the investment or the aggregate demand rather, AD goes down. Okay, so as the business confidence goes up, AD goes down. All right, next up you have government spending or government investments. So this has to do with government infrastructure. All right, so you have government investments. So when it comes to your government investment, a reduction in government spending. So let's say government spending is reduced. Okay, government spending is reduced as a result of which your aggregate demand, okay, will go down as well. Okay, so since government investment makes up a component of your real GDP and aggregate demand, if this goes down, this is directly proportional to your aggregate demand, as a result of which your aggregate demand will go down. Okay, next up, you have rise in taxes. So as taxes go up, your aggregate demand goes down. So aggregate demand, okay, and aggregate demand because of government investment will go down. All right. So if the government, for example, makes an investment, let's say government does invest in infrastructure because of which the taxes go up, because obviously you have to maintain that infrastructure, whether it's a highway, whether it's a road, whether it's a construction project, you have to maintain that infrastructure, as a result of which if the taxes go up to fund the development and maintenance, okay, the aggregate demand of the general public in that investment will go down. Okay, the aggregate demand of goods and services will go down, and the real GDP will go down. All right, now apart from that, if the government investment does go up for whatever reason, okay, let's say government spending on infrastructure projects, okay, goes up, okay, this will mean that your aggregate demand will go up as well. Okay, so this is spending. So over here, your aggregate demand will go up. All right, apart from that, you have reduction in taxes. So let's say taxes are reduced. Okay, so reduction in tax. So when the taxes are reduced, your aggregate demand is reduced. All right. Next up, you have net exports. So when it comes to net exports, okay, reduction in foreign demand. So let's say the foreign demand is reduced. And because the foreign demand is reduced, what's going to end up happening is, okay, your net exports, okay, your aggregate demand will be reduced as well. Okay, and when we say foreign demand, we're talking about foreign demand for consumer goods. Okay, so let's say you have another country that has a certain demand for your consumer goods, the consumer goods that you produce within the country. If that demand goes down, let's say because of high exchange rates or because of foreign policies, whatever the reason might be, because of tariffs, okay, your net exports will go down. All right, and then you also have price level or price of US goods or price of goods in general. Okay, so price of goods. As the price of goods go up, the net exports go down. All right, on the other side, if there is an increase in demand, let's say foreign demand, so let's say your foreign demand goes up, all right, what's going to happen is your net exports, okay, will go up. Okay, so if foreigners are able to spend more money, okay, the net exports, the exports when it comes to goods and services will go up. All right, price drop of US goods, so as the, okay, the price level drops, so let's say the prices, okay, your net exports will go up. Okay, so if price levels drop, net exports will go up. And we've seen that in a recession. Okay, occasionally when you do have the constriction or contraction of an economy, okay, because of which the currency exchange rate may go down. And if the currency exchange rate goes down, it may lead to high net exports. because once your currency exchange rate is down, okay, foreign companies, okay, foreign investors, foreign nations, okay, will be able to invest more, okay, because obviously the less the price, the better. The less the price, the more the demand. As the price goes down, the demand goes up. Similarly, the same manner, okay, as the currency exchange rates go down, okay, the foreign investors have to spend less for the same amount of investment, okay, and their return on investment may be far greater than if they were to invest in a country with a high exchange rate. All right, so that would be it when it comes to economic factors that impact the four components of aggregate demand or real GDP. On behalf of Electronics, this is Obaid. Have yourself a great day.